Okay, so hi everyone. Welcome to today's webinar brought to you by Vantage. Today is the 17th of February. It is Chinese New Year here. It is a public holiday. Just gonna finish up this one for you guys, and then we can all go celebrate Chinese New Year. Okay, I think most of you are a lot. I see Chinese names here, so there are people here who are not even with their family yet. Okay, so last push before we start the holidays. Okay, so Middle East risk and the oil price machinery. Another one of these topics where it is good to know this. Okay, it is very good. It will change your perspective on the markets. You won't just look at the market as like a simple like technical analysis. I can solve the market with just a simple technical analysis point of view. Nope. This will help you see the markets from a different point of view where you will start to kind of understand that everything is interlinked in one way or another. Okay, so before I actually start, you guys know how this works. I do need to go through the disclaimer. Okay, disclaimer. I'm gonna have to stay here for a minute or two later on so you guys can read through it. But basically, it is a reminder that anything that I share in this webinar should not be construed as any form of trading advice, any form of financial advice, any signal to buy or sell. I am not telling you guys to buy or sell anything. Okay, I am here to share my research. Putting eye drops. My eyes are burning. Okay, I'm here to share whatever I've researched on this topic. You must be wondering who am I to be sharing whatever I've researched. I will share. I will explain in a bit who I am for those who don't already know. I don't really. I think the most of you already know who I am because I'm looking at the attendees from Zoom, and all of you are regulars. Every one of you, Helen, Kirsten, Rob, Muhammad, Joash, Bob, Ricardo. Okay, you are all regulars, and yeah, the rest of you. Okay, you guys are regulars, so I don't even need to introduce myself, but I will have to still. Okay, please read the disclaimer. I'm gonna have to stay here for a minute or two so that you guys can actually read it. Do remember that the whole point is to remind you guys that trading is risky and not to jump into it blindly. Okay, cool. Okay. I think that should be enough for you guys to read through the disclaimer. I do not want to waste too much time because today's topic is very heavy, as in like content heavy. So let's not spend much time on that. Okay, so again, quick one. My name is Cassandra. You guys can call me Cass. I'm an investment analyst. You guys already know that. With Adverse Fortune Group, we are a research firm based in Singapore. We have been recognized as the finalist for the best forex and best equity research for multiple years running. Okay, on top of that, I'm also a prop trader. That means that I'm funded by multiple companies. How do I get that funding? Technical analysis, fundamental analysis, combination of both, and then I get high probability setups. It's actually this is a trading is a fun game to me because I have become so accurate in it, I would say, good at it. So if you guys have any questions you want to ask me in the chat box. It doesn't even have to be related to today's topic. Anything trading related, ask me in the chat box. Any way I can help you at all, I will try my best to help you. I mean, that's the whole point of Vantage inviting us onto these webinars is to help you guys go through whatever challenges you are facing. Okay. Our agenda for today, we're gonna understand the Straits of Hormuz. Hormuz, I don't know if I'm pronouncing that right, and oil supply vulnerability, regional conflicts with Iran, Israel, and allied responses, oil price reaction functions and macro amplifiers, risk sentiment, safe havens and currency flows, and last but not least, scenario planning, escalation, containment, and market behavior. Okay. Okay, so let's start with the Strait of Hormuz. I really don't know if there's a special way to pronounce it. I'm just pronouncing it as the best that I can. And oil supply vulnerability. Okay, so as we discuss, the Middle East is risk is in the financial markets, we are not simply referring to headlines or episodic geopolitical tension. We are referring to structural vulnerability embedded with the global energy system. And at the center of that system sits the Strait of Hormuz. Okay, the Strait of Hormuz is not just a narrow maritime passage, okay, between Iran and Oman. It is the primary artery through which a significant share of the world's seaborne crude oil flows. Okay, roughly one fifth, yes, one fifth, 20% of global oil consumption moves through this corridor every single day. Like, they don't care if it's Christmas, Chinese New Year, Easter, whatever, Hari Raya, whatever you can think of, oil is flowing through this corridor every single day. Okay, that figure alone tells us something very important. This is not a regional issue. It is a global macro variable. Okay, so the global economy remains structurally dependent on oil, even in an era of energy transition narratives. Transport systems, petrochemicals, industrial production, aviation, shipping, and large segments of emerging market development continue to rely heavily on stable oil flows. When nearly 20% of global oil trade passes through a narrow waterway that is geopolitically exposed and politically sensitive, markets must price that vulnerability. Now, what makes the strait uniquely sensitive is not just the volume of oil, but the concentration of exporters behind it. So we've got Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, UAE, and Qatar all rely heavily on this route. They are some of the largest hydrocarbon exporters in the world. When we think about supply risk, we are not thinking about marginal barrels. We are thinking about systemic um, supply. Okay. It is also important to understand that alternatives are limited in the short term. They are pipeline bypasses, particularly for Saudi Arabia and the UAE, but their capacity does not fully offset the volume that would be disrupted in a severe closure scenario. This means that if flows are materially impeded, okay, the market does not have an immediate logistical solution. And when markets recognize that, the price risk premiums accordingly. From a macro perspective, the Strait of Hormuz represents leverage, not necessarily because it will be closed, but because it could be. Okay, the possibility itself alters expectations, and in financial markets, expectations are often more powerful and realized events. The oil market does not wait for tankers to stop moving before repricing. It reacts to possibility disruptions. It reacts to perceived escalation risk. It reacts to signals that suggest the flow of oil could be interrupted. That is where the transmission mechanism begins. A geopolitical tension in a narrow strait can cascade into global inflation expectations, monetary policy recalibration, currency repricing, and equity volatility. Understanding the choke point is the foundation for understanding the broader machinery of oil price reactions. It is not about drama, it is about structural exposure embedded in the plumbing of the global economy. Okay, so let's look at the physical disruptions versus risk premium and how the markets price threat. Okay, so one of the most important distinction in macro analysis is the difference between physical disruption and risk premium. Markets do not require a full closure of the Strait of Hormuz to react. They require only a credible increase in probability. Let us think through the mechanics. If tensions rise and shipping companies perceive elevated danger, insurance premiums for tankers immediately increase. War risk premiums are added, shipping costs rise. Some vessels may delay transit even without a single missile strike or naval blockade. Friction in the system begins to appear. Oil prices are forward-looking. Futures contracts begin to reflect higher near-term uncertainty. The front end of the curve may shift into backwardation as traders price tighter prompt supply. This repricing can occur rapidly because oil is globally traded and deeply financialized. Hedge funds, commodity trading advisors, and institutional participants respond quickly to changes in perceived geopolitical probability. At the same time, policymakers begin evaluating response options. Strategic petroleum reserves may be discussed. The United States, China, and other large consumers hold reserves that can be released to smooth temporary disruptions. However, reserves are finite and politically sensitive. Markets understand this. Therefore, even the disruptions of reserve releases signals that something is structurally tight. Spare production capacity becomes critical in the environment. If OPEC producers, particularly Saudi Arabia, have unused capacity, markets may interpret that as a buffer. If its spare capacity is already limited due to production, discipline, or structural underinvestment, then the perceived cushion is thin. In that scenario, even minor disruption risks can produce outsized price reactions. The key macro insight here is that oil prices embed probabilities, not certainties. Okay, so a 10% chance, severe disruption, can, materially move prices if the economic consequences of the disruptions are large enough. This is the expected value pricing in action. When oil prices rise due to risk premium rather than realized shortage, the macro implications can be substantial. Inflation expectations responds to price levels, not to costs of those price levels. Central banks must react to realized inflation prints, regardless of whether the source was physically scarcity or geopolitical tension. So the transmission mechanism does not wait for physical closure. It begins when the market recalibrates risk. Okay, so once oil prices begin to rise, whether due to physical disruption or risk premium, the next stage of the machinery activates. The stage is inflation transmission. Energy is embedded in nearly every economic activity. When crude oil prices increase, refined products such as gasoline, diesel, and jet fuel rise as well. Transport costs increase, freight becomes more expensive, airlines adjust ticket prices, logistics firms raise rates, industrial producers face higher input costs. These cost pressures feed directly into headline inflation. Consumers experience higher fuel costs almost immediately. That visibility matters. Energy inflation is highly salient. Okay, it shapes household expectations above future prices. Even if core inflation remains stable initially, elevated energy costs can shift inflation psychology. For central banks, this creates delicate balance. Monetary policy cannot pump more oil. Central banks cannot resolve geopolitical tension in the Strait of Hormuz, but they are responsible for price stability. So if rising oil prices begin to re-anchor inflation expectations higher, policymakers may feel compelled to maintain higher policy for longer. So now consider a feedback loop. Higher oil prices compress real incomes. Households spend more on energy and have less discretionary income. Consumptions low, growth expectations soften, equity markets begin to price margin pressure for energy intensive sectors. Bond yields may initially rise on inflation fears, but later fall in growth concerns dominate. Currencies respond differently depending on their exposure. Oil importing countries may see deteriorating trade balances. Oil exporting countries may benefit from improved terms of trade. The US dollar may strengthen if global risk aversion rises, even though the US is also an oil producer. The interplay becomes complex. What becomes as a narrow maritime vulnerability becomes a broad macro event. Oil prices influence inflation's data. Inflation data influence central banks' communication. Central bank communication influences financial conditions. Financial conditions influence asset valuations. And throughout this process, markets are constantly updating probabilities. Was the straight disruption temporary? Is the risk premium justified? Will diplomatic channels de-escalate tensions? Each new piece of information shifts expectations. This is why understanding the Strait of Hormuz is not about memorizing geography. It is about understanding how to localize geopolitical risk transmit through commodities, inflations, policy, and ultimately global asset prices. Okay, so let's move on to the regional conflict of Iran, Israel, and allied responses. This is okay, so how do I explain this? Okay, so to understand oil price behavior in the context of the Middle East risk, we must first understand the regional power architecture. Okay, so the tension between um, Iran and Israel is not episodic. It is structural in a way. It is rooted in strategic doctrine, ideological positioning, and regional influence competition that has evolved over decades. Okay, so Iran's regional posture is not confined to its own borders. It operates through a network of aligned non-state actors and political affiliates across Lebanon, Syria, Iraq, and Yemen. The network creates what is often described as strategic depth. It allows influence without direct conventional confrontation. It also creates ambiguity. Escalation does not always begin with state-to-state engagement. It can begin through proxies. Israel's doctrine, on the other hand, is centered around deterrence and preemption. Its security strategy has historically emphasized maintaining qualitative military superiority and responding decisively to perceived existential threats. Okay, when Israel leadership assesses that regional actor is approaching a strategic threshold, particularly in areas such as missile capability or nuclear development, it has shown willingness to act. So overlaying this bilateral tension in the United States security umbrella, the US maintains significant military presence in the region, both directly and through alliances with Gulf states. American naval assets routinely patrol the Persian Gulf. US policy signals often act as a stabilizer, but they can also become escalation variables depending on the global political environment. What happens for markets is not simply who is aligned with whom. What matters is how escalation pathways are structured. In a region where state and non-state actors interact fluidly, the escalation threshold is not always clear. That ambiguity increases uncertainty premiums. Financial markets respond to probability weight scenarios. If a direct confrontation between Iran and Israel is perceived as unlikely, oil prices may not respond materially. But if a proxy engagement intensifies or if theoretic suggests political direct strikes, the perceived probability distribution shifts. And that shift alone can it could be sufficient to reprice energy market. Okay, the regional architecture therefore acts as a framework in which oil risk is assessed. It is not about single headlines, it is about structural tension that periodically rises and falls intensively. Okay, so let's talk about allied responses and the globalization of regional conflict. Regional conflict in the Middle East does not remain regional for long. It quickly becomes global through energy channels, alliance commitments, and financial linkages. When tensions rise between Iran and Israel, the United States faces strategic decisions. Does it reinforce deterrence visibly by increasing naval presence? Does it prioritize diplomatic de-escalation? Does it tighten or relax sanctions enforcement on Iranian oil exports? Each of these decisions influences the oil supply outlook. Sanctions are particularly important. Iranian oil exports have fluctuated significantly depending on enforcement intensity. When the enforcement tightens, barrels effectively leave the global market. When enforcement eases, supply increases, even if formally sanctions remain in place. This creates a shadow supply mechanism that markets monitor closely. Gulf states, particularly Saudi Arabia and the United UAE, must balance regional security with economic objective. They benefit from higher oil prices to a degree, but they also depend on a stable global demand and investment flows. Escalation that becomes uncontrollable is not in their economic interest. Therefore, their diplomatic positioning can sometimes act as a moderating force. Europe's role has evolved as well, okay, particularly after the Russia-Ukraine conflict reshaped energy security thinking. European policymakers now view Middle East stability not as a distant concern, but as a directly linked to their own inflation and industrial competitiveness. Energy diversification strategy have accelerated, but vulnerability remains. The globalization of regional conflict means that oil markets are not merely reacting to local events. They are reacting to anticipated responses by major powers. If markets believe that escalations will trigger coordination, naval protection, strategic reserve releases, or diplomatic intervention, the risk premium may be contained. If markets believe that the responses will be fragmented or politically constrained, the premium can expand. In macro terms, it becomes a question of policy credibility. When governments are perceived as capable of containing shocks, financial markets remain more stable. When policy capacity is doubted, volatility increases. The machinery of oil pricing therefore incorporates not only the conflict itself, but the anticipated response architecture around it. Okay, so um, one of the most misunderstood aspects of geopolitical risk is its non-linear impact on the markets. Not all conflict produce the same oil price response. In fact, markets can become desensitized to recurring low intensity conflicts. Okay, so if minor proxy engagement occur repeatedly without significant supply disruption, markets may begin to discount them. The risk premium embedded in oil prices gradually compresses. Traders become conditioned to expect containment, volatility declines. However, this conditioning creates fragility, okay, when the threshold event occurs that derives from the expected pattern, the price reactions can be sharp. A direct strike on critical infrastructure, a naval confrontation in a shipping lane, and a miscalculation leading to broader engagement can produce a rapid repricing. Financial markets are often positioned based on recent experience. If positioning is skewed towards complacency, a surprise escalation forces rapid adjustment. Short position in oil may be covered aggressively. Volatility clusters, liquidity thins temporarily, risk assets reprice. The asymmetry is important. Okay, so the downside moves in oil during the de-escalation tends to gradually um, sorry guys. Like okay, sorry guys. There was an error that came out. Okay, so upside moves during escalation risks tend to be sharper because of convexity in disruption probability. A small increase in this likelihood of severe disruption can produce a disproportionate price move. From a macro perspective, the non-linear behavior be matters because it influences financial conditions abruptly. Sudden oil spikes can shock inflation expectations and asset correlations. Equity markets may initially fall on growth fears while energy equities rise. Bond markets may struggle between inflation and safe haven flows. The relationship between conflict intensity and oil price is therefore not linear. It is regime dependent. Markets oscillate between complacency and alarm. Understanding where we are in that cycle is critical for interpreting price action without overreacting to every headline. In institutional macro thinking, the goal is not to predict the exact path of escalation. It is to map the probability disruption and recognize how markets are positioned relative to that disruption. Okay, so let's move on to oil price reaction functions and macro amplifiers. Okay, when we speak about oil price reaction functions, we are referring to a systemic or systematic way in which oil prices respond to changes in underlying drivers. This is not random, it is structured. Oil prices react differently depending on whether the shock originates from supply, demand, or expectations about future policy. Let us begin with supply shocks. A supply shock typically emerges from geopolitical disruption, production cuts, sanctions, or infrastructural damage. When supply risk increases, prices tend to rise, particularly in the front end of the future curve. The degree of the rise depends on available buffers. If inventories are high and spare capacity is ample, the price response is more contained. If inventories are low and spare capacity is thin, the reaction can be magnified. So demand shocks are different. When global growth accelerates, oil demand rises, pushing prices higher in a more gradual fashion. When global growth slows, oil demand contracts and prices fall. Demand-driven oil moves tend to be correlated with a broader risk appetite. Supply-driven moves are more inflationary and destabilizing. But most of the important layer is expectations. Oil markets are forward-looking, okay? Again, like a lot of other markets, traders evaluate not just what is happening today, but what might happen over the next 6 to 12 months. If markets anticipate that a geopolitical shock will be temporary, the futures curve may steepen and flatten accordingly. If markets anticipate a prolonged structural shortage, the entire curve shifts upwards. Um, Inventories act as shock absorbers. When OECD inventories are elevated, price spikes may fade more quickly. When inventories are depleted, volatility becomes amplified. The same is true of OPEC's spare capacity. It is not merely a statistic, it is a stabilizer in the pricing mechanism. Time horizon matters as well. Okay, short-term supply disruption may create sharp spikes that reserve once flow normalize. Long-term structural underinvestment in energy, however, can create persistent upwards pressure. Understanding the oil price reaction functions requires recognizing that markets respond not only to the magnitude of the shock, but to the context in which it occurs. A geopolitical flare-up in the tight market environment produces a very different outcome than the same flare in the surplus environment. This layered structural is what allows macro strategists to interpret price moves without oversimplifying them. Okay, so oil does not operate in isolation. I put an example of the CPI data here. Okay. Okay, so once price rises, a series of macro amplifiers can transform a commodity shock into a broader inflation regime shift. Energy has a different weight in consumer price indices. In some economies, that weight is modest, in others, it is significant. But the direct impact is only the first stage. The second stage involves pass-through effects. Transportation costs will rise. Logistics firm adjust pricing. Airlines, shipping companies, and manufacturing firms begin re-collaborating cost structures. Over time, if higher energy costs persist, business attempt to preserve margins by passing costs on to customers. The third stage involves wage dynamics. If households experience persistent energy-driven inflation, right? They begin to demand higher wages to protect purchasing power. If labor markets are tight, wage growth may accelerate. This creates a second round effect. Now, inflation is no longer purely energy driven, it becomes embedded. Central banks are particularly sensitive to the transition. If inflation expectations begin to drift upwards, okay, policymakers must signal resolve. Credibility becomes critical. If markets believe that central banks will maintain restrictive policy until inflation is contained, expectations may stabilize. If credibility is questioned, the amplification intensifies. This is where oil shocks intersect with monetary policy. A supply-driven oil spike can produce the uncomfortable combination of slower growth and higher inflation. This resembles the stagflationary impulse. Policymakers face a dilemma: tighten policy and risk assessment or tolerate higher inflation and risk de-anchoring expectations. Historical memory matters. The oil shocks of the 1970s demonstrated how energy price surges could reshape inflation regimes. Modern economies are more diversified and energy efficient, but the transmission mechanism still exists. Macro amplifiers therefore determine whether an oil price spike remains a temporary fluctuations or evolved in a broader structural challenge. So once oil prices move and macro amplifiers begin operating, the effects propagate across asset classes. Okay, bond markets respond first through inflation expectations. Break-even inflation rates often rise when prices spike. Nominal yields may increase as investors demand compensation for higher expected inflation. However, if growth fears intensify simultaneously, long-end yields may eventually decline as recession risk grows. The yield curve can flatten or invert depending on the balance of forces. Equity markets react in a differentiated manner. Energy producers may benefit from higher prices, at least initially. Energy-intensive sectors such as transportation, manufacturing, and consumer discretionary may face margin compression. Broad indices often struggle when oil shocks are perceived as growth negative rather than demand driven. Credit markets are particularly sensitive. Higher energy costs can erode corporate profitability. Increasing default risk is vulnerable sectors. Credit spreads widen as investors demand higher compensation for risk. Financial conditions tighten. Liquidity becomes an important amplifier in an environment where global liquidity is already constrained, perhaps due to central bank tightening. Oil shocks can exacerbate volatility. In a highly liquid environment, the same shock may be absorbed more smoothly. Currencies also react through terms of trade effects. Okay, oil exporting countries may see currency appreciate if higher prices improve trade balances. Oil importing countries may face depreciation pressures. The US dollar's role is complex. It often strengthens during global risk aversion, even if higher oil prices contribute to domestic inflation. This cross-asset transmission illustrates why oil is not merely a commodity story. It is a macro variable that interacts with financial conditions, investor positioning, and policy expectations. The reaction functions of oil prices combined with macro amplifier determine whether the geopolitical shock remains contained within commodity markets or evolves into a broader financial cycle shift. Okay, so let's talk about risk sentiment, safe havens, and currency flows. So when geopolitical tension rise in the Middle East, particularly when oil supply vulnerability becomes a focal point, the market response does not remain confined to commodities. It quickly becomes a question of global risk sentiment. Financial markets operate in cyclical regimes. They are periods characterized by risk-taking, abundant liquidity, and compressed volatility. And there are periods characterized by capital preservation. Rising volatility and tightening financial conditions, geopolitical shocks often act as catalysts that accelerate transitions between these regimes. In the early stages of a Middle East escalations, equity markets may initially interpret rising oil prices as a single signal of inflation risk. If inflation expectations increase, bond yields may rise, which precious equity valuations. Growth-sensitive sectors begin to reprice. Technology and consumer discretionary sectors, which are sensitive to discount rates and demand expectations, often feel pressure first. At the same time, volatility indices tend to rise. Volatility is not merely a reflection of fear, it is a mechanism that changes investor behavior. While when volatility increases, leverage is reduced, risk parity strategies adjust allocation. Thematic funds rebalance exposures. The mechanical response can amplify price moves beyond what fundamentals alone would justify. Liquidity preference shifts as well. Investors move from higher beta assets towards more defensive exposures. Emerging markets, particularly those that are net oil importers, may experience capital outflow. Developed market government bonds may initially receive inflows through, the response can be complicated if inflation expectations are rising simultaneously. Okay, so the critical insights is that geopolitical shocks interact with existing positioning. If markets are heavily positioned for stability and low volatility, the unwind can be sharp. If markets are already cautious, the incremental reactions may be more muted. Thus, the Middle East risk feeds into the broader global risk cycles, not only through energy price, but through behavioral and mechanical adjustments in capital allocations. Okay, so when uncertainty rises, markets gravitate towards perceived safe havens. But safe haven behavior is nuanced and depend on the nature of the shock. The US dollar frequently strengthens during geopolitical stress. This is partly because global trade and finance remain heavily dollar denominated. When uncertainty rises, global institutions demand liquidity. Dollar funding markets tighten. The currency benefits from its reserve status. However, the dollar's response can be moderate if the oil shock significantly worsens US inflation expectations. If markets anticipate that higher oil will complicate Federal Reserve policy, the interplay between inflation risk and safe haven demand becomes more complex. The dollar may strengthen initially on a risk aversion, then stabilize as rate expectations adjust. Gold often performs well during geopolitical tensions, particularly when the shock is perceived as systemic rather than temporary. Gold's appeal lies in its lack of credit risk and its historical role as a store of value. If oil-induced inflation pressures coincide with doubts of policy credibility, gold may benefit from both safe haven and inflation hedge flows. US Treasuries are traditionally a safe haven as well. Yet here we encounter an interesting dynamic. If oil shocks drive inflation expectations higher, nominal yields may rise, reducing bond prices. But if growth fears dominate, long duration bonds may rally as recession risk increases. The balance between inflation and growth expectations determines the direction of bond markets. This balance can shift rapidly. In the early phase of a shock, inflation may dominate. In later phases, growth concerns may take precedence. Safe haven flows therefore reveal how markets interpret the nature of the shock. Is it inflationary? Is it growth negative? Is it systemic, or is it likely to be contained? These interpretations evolved over time, and assets prices adjust accordingly. Oil price movements influence currencies through term of trade effects. Countries that export oil generally benefit from higher prices. Their trade balances improve, government revenues increase, fiscal positions strengthen, at least temporarily. This can support their currencies. Conversely, oil importing countries face deteriorating trade balances when prices rise. More foreign currencies must be allocated to energy purchases. This creates depreciating pressure, particularly in economies with existing external imbalances. Emerging markets are especially sensitive. Many emerging economies are net energy importers with limited fiscal flexibility. Higher oil prices can widen current account deficits, pressure currencies, and increase sovereign risk premiums. If global risk sentiments simultaneously deteriorates, capital outflows may intensify. Petrodollar recycling also plays a role. Oil exporting nations accumulate dollar revenue when prices are high. These revenues are often reinvested in global financial assets, including US Treasuries and global equities. The timing and scale of this recycling can influence global liquidity conditions. However, the adjustment process is rarely smooth. Currency markets can overshoot Speculative positioning may exaggerate moves. Central banks in emerging markets may intervene to stabilize currencies, drawing down reserves or adjusting policy rates. In macro terms, oil-induced currency adjustment illustrates how commodity shocks redistribute income globally. They shift purchasing power from an importer to exporter. They alter capital flow towards. They influence inflation trajectories in different economies. The intersection of oil prices, risk, sentiment, and currency flows is therefore a complex web of interdependencies. It is not a single directional trade. It is a network of adjustment that unfold across multiple time horizons. Understanding these linkages allows us to integrate currency volatility with broader macro context rather than viewing it as an isolated function. Okay. Okay, so let's go into our very last topic today, which is the scenario planning, escalation, and containment and market behavior. And then we will end it with a Q&A session if you guys have any questions. If you guys don't have questions, yeah, it's okay too. So when we engage in scenario planning, the objective is not prediction, it is preparation. We construct structures, pathways through which events may unfold, and then evaluate how markets are likely to behave within those pathways. Let us begin with the escalation scenario. In this case, tension begins, regional actors intensify beyond contained proxy engagement. Shipping through the Straits of Hormuz becomes materially disrupted either through direct confrontation, mining of shipping lanes, or sustained military friction that deters commercial transit. Oil prices may likely respond sharply and immediately. The initial spike would reflect repricing of supply probability, but the more important question would be duration. If disruption appears persistent rather than temporary, the future curve would shift upwards across maturities. Backwardation would deepen in the front end, reflecting acute scarcity, while longer date contracts would price sustained structural tightness. Inflation expectations would begin to re-escalate. This would be particularly significant if the global economy were already operating with limited slack. Central banks would face intensified constraints. Even if growth momentum weakens, policymakers may be reluctant to ease policy aggressively if inflation risk resurfaces. Financial conditions would tighten through multiple channels. Higher energy costs would compress corporate margins. Consumer confidence would deteriorate. Credit spreads would widen as investors demand compensation for increased uncertainty. In equity markets, we would likely observe divergence. Energy producers and certain defensive sectors may initially outperform. Broad indices may struggle as growth expectations decline. Volatility would remain elevated for an extended period rather than subsiding quickly. Bond markets would face a dual force. Inflation pressure would push yields upwards, while recession fears would pull longer maturities downwards. The yield curve would or could flatten or invert future depending on the intensity of the growth slowdown. Currencies markets would experience pronounced asymmetry. Oil exporters may benefit from improved trade balances, but only if the financial stress does not dominate. Okay, so emerging markets reliant on energy imports could face acute depreciation pressure. The key macro insight is an escalation scenario is that oil ceases to be merely a price variable. It becomes a regime variable. It reshapes expectations about inflation, policy, and growth simultaneously. However, It is important to emphasize that even escalation scenarios, market condition continuously update probability. If diplomatic breakthrough emerge, repricing can occur rapidly in the opposite direction. Therefore, scenarios planning must remain dynamic. Okay, so in contrast to escalation, the containment scenario assume that tensions must rise, but are ultimately managed. There may be localized incidents, rhetoric, or limited strikes, but shipping lanes remain operational and major oil infrastructures remain intact. In this environment, oil prices may initially spike, but subsequently retrace as the market recognizes that structural supply remains intact. Risk premiums compress, the future curve flattens as immediate scarcity feels displaced. Okay, so strategic petroleum reserve releases may be deployed as confidence building measures. These releases serve not only as to increase supply temporarily, but to signal coordination among major consuming nations. Okay, so policy signal can be as useful as physical barrels in stabilizing expectations. Okay, so the important macro takeaway is that the markets are adaptive. If the perceived probability of severe disruptions decline, asset prices recalibrate quickly, and the containment scenario underscores the importance of not extrapolating initial price spikes into permanent regime changes without confirmation. Institutional investors constantly weigh this possibility. They avoid binary thinking, they assign conditional likelihood and adjust exposure as evidence accumulate. Okay? So, let me see. Am I Okay, that's it. We are done with today's webinar. I hope you guys took something away from this webinar, but more importantly, if you guys have any questions for Vantage or you want to follow any news updates, do follow them on their handles. They have Facebook, Instagram, X, LinkedIn, and Telegram. These are the handles. I'm gonna stay here for a bit. Okay, cool. So that's all I have for you guys. If you guys don't have any question, I mean, I don't really see the chat box moving today. It's a bit quiet today because I think it's a public holiday. Today's the attendance list is like half of what it usually is for Zoom, and I can't even log into. We're not even streaming on Vantage app. So, those who came and attended today, thank you so much. Happy Chinese New Year from me as a Chinese person. So basically, um, thanks for coming, and I will see you guys in a week. So next week, I've got another topic for you guys. Obviously, it's another fun economic topic, another informative topic. So I hope you guys join in because joining these webinars will help you see from a different perspective, which will help you become a better trader ultimately. Because the more information you have, the more you can filter in your head and you know what information is useful to you and what's not useful to you. Okay, so bye everyone. Thanks for joining. Take care. See you guys next week. Bye.